Right now, in January 2026, the United States government officially holds 8,133 metric tons of gold. On the balance sheet, that hoard is carried at $42.22 per ounce. That is the statutory price set in 1973. The market does not care. The actual price today sits above $4,600 per ounce. Do the math. At market prices, that is a hidden asset worth over $1.2 trillion. On the books, it shows up as roughly $11 billion. A gulf of about $1.2 trillion between official ink and market reality. A gap big enough to change the trajectory of a nation, and with a single decision, they can close it overnight. With a pen, why would they do it? Because when the numbers stop adding up, governments reach for the same lever. They reprice the anchor. If you are parked in cash when that happens, you stand on the wrong side of the largest wealth transfer in American history. Not hype, not fantasy. This sequence has played out before, twice. Both times, holders of paper lost. Both times, the government escaped crushing debt. April 5th, 1933. President Roosevelt makes private gold ownership illegal through Executive Order 6102. Imagine the feeling, fear in the air, people surrendering the one asset they trusted. Citizens were forced to turn in their gold at $20.67 per ounce. 9 months later, January 1934, the government revalues that same gold to $35 per ounce. A 69% gain for the Treasury overnight, zero gain for the citizens who handed it over. They received $20.67. The government immediately marked it at $35, instant wealth transfer. Do you see the asymmetry? August 15th, 1971. President Nixon closes the gold window, ending dollar convertibility to gold. Officially, gold still sat at $35 per ounce. The market had other plans. Within 9 years, the price exploded to $850 per ounce, a 2,329% move. Anyone holding physical gold multiplied their wealth roughly 23 times. Anyone sitting in dollars or bonds was crushed by the inflation that followed. Savings eroded. Promises shrank. The story was the same. The mechanics were the same. The psychology was the same. There is a precise 4-stage pattern when debt becomes mathematically unpayable. It has executed twice in modern American history, and once it begins, it has never failed to complete. Stage 3 is already done. We are waiting for Stage 4. Why does this happen? Because arithmetic wins. When obligations outrun income, something has to give. Taxes cannot rise fast enough. Growth cannot outrun compounding promises. So the price system is used to do the dirty work. The unit is weakened. The anchor is revalued. Debts become smaller in real terms. The ledger is fixed by changing the scale. Listen to the human side of it. Fear makes people cling to cash. They feel safe. They think liquidity equals security. Greed tempts others to chase whatever is rising that month. Panic makes almost everyone sell the right things at the wrong time. Meanwhile, the policy machine grinds forward, quietly, predictably. It tells you exactly what it will do if you listen to the math. In 1933, citizens complied, believing the law would protect them. In 1971, savers trusted the peg, believing promises would hold. In both cases, the rules changed. The value moved. Purchasing power flowed from the public to the issuer. The crowd learned too late. Look at today. The gap between the book price of the nation's gold and the market price is not a rounding error. It is a loaded spring. $1 trillion spread sitting in plain sight. If historical patterns hold, that spread gets closed with an announcement. No vote. No weeks of debate, just a statement, a new number, and in that instant, wealth shifts from paper to hard collateral. Do you see the pattern? The sequence, the emotions, the result, it is not complicated. It is mathematically predictable. Once it starts, it finishes. When that day comes, you will not get a phone call first. It will happen between one headline and the next. So ask yourself now, where do you want to stand when the repricing hits? On the side of paper that dissolves, or on the side of assets that survive resets? The pattern is simple. The math is relentless. Stage 3 is behind us. Stage 4 is ahead. 4 distinct stages. Every single time, once you spot the pattern, you cannot unsee it. You know what comes next, and why it is almost impossible to avoid. Stage 1. Government debt climbs to a critical line somewhere between 90% and 130% of GDP. It creeps up quietly, war by war, crisis by crisis, program by program. Each one sold as urgent, necessary, humane. But the math does not care about slogans. There is a moment, a closed room, a late-night briefing. Someone runs the numbers. The truth lands like a brick. Taxes cannot save them. To raise enough, they would have to crush the economy they are trying to protect. Growth cannot save them. Debt is compounding faster than output. Printing cannot save them. Print enough and you torch the currency. You burn trust. You invite panic. Shelves empty. Streets turn angry. So they are trapped. You can feel it in the tone of the press conference, in the carefully chosen words. Debt too big to pay. No painless exit. Every door leads to pain. Which one will the system pick? Do you see the setup? That is stage 1. Stage 2, the dollar's credibility cracks. Maybe just a hairline at first, then wider. The world begins to doubt foreign governments, foreign central banks. Big pools of capital that do not do hope, they do math, they do survival. They ask a simple question. Will these dollars hold value in the years ahead? Or are we the last ones at the table holding the bag? When doubt rises, they move. Out of paper promises, into things with weight, things you can touch. We have seen this movie. In 1933, it was the public at home. Lines at the bank, not for cash, for gold. People did not trust the system, so they reached for the only anchor they knew, not a theory. A reflex born of fear. In 1971, it was foreign governments, France under Charles de Gaulle, Germany, Switzerland, quiet phone calls, firm demands. Dollars for gold, please, not later, now. They did not hate the dollar. They doubted the promise behind it. There is a difference, and it matters. Today, in 2026, look at the posture. China and Russia are building gold reserves with intent, not by accident. At the same time, they push yuan-denominated trade, gold-backed settlement ideas, anything that chips away at dollar dependence. Is it a coup? No. It is a hedge, a message, a plan B that grows more attractive as plan A looks shaky. Why does this happen? Because confidence is the real reserve. Not the ink, not the paper. The belief that tomorrow's dollar buys tomorrow's goods. When that belief wobbles, capital gets nervous. And nervous money is fast. It does not wait for speeches or charts. It moves first. It asks permission later. So capital flight begins. Quietly at first, then obviously out of dollar-denominated assets into alternatives, safer harbors, shorter durations, harder stores. Sophisticated investors refuse to be the last ones holding a currency that is losing face and losing purchasing power in real time. They have seen how this story ends. They have learned the hard way that hope is not a hedge. Do you see the pattern now? Fear meets leverage. Doubt meets policy, and the market does the rest. Stage 3, the quiet stage. Government gold reserves stay frozen while the national debt rockets higher, not inching, exploding. And everyone pretends that nothing is happening. The United States has held exactly 8,433 metric tons of gold since 1971. That stack has not moved in 55 years. Not an ounce added, not an ounce sold. It sits where it has always sat, Fort Knox, West Point. The New York Federal Reserve vaults, silent, cold, untouched. Investors glance at it and look away because it does not flicker like a stock chart. Because it does not shout. On the Treasury's books, that gold is still carried at a statutory price of about $4,222 per ounce. Paper value? Legacy number, the actual market price today is roughly $4,600 per ounce, 109 times higher than the official book value. Do you see the gap? On paper, small. In reality, massive. A hidden asset hiding in plain sight. This is why it feels surreal. The government is sitting on over $1.2 trillion in real market value that does not show up on the balance sheet at current prices. It exists. It is real. It is not marked. It is recorded using 1973 accounting, as if time stopped, as if the world did not change. Why keep it that way? Because stability is a story, and stories calm crowds. Meanwhile, the debt machine roars. Politicians promise. Central bankers soothe. Investors chase yield and momentum. Greed whispers, you are missing out. Fear whispers louder, do not be the last one holding the bag. Normalcy bias does the rest. Nothing moves until it does. Stage 4, the revaluation event. Not a market drift, a policy strike. The government marks its gold to market through official action, not a debate. Not a hint, a switch. Here's the mechanism, and it is brutally simple. The Treasury Secretary, working with the Federal Reserve, revalues gold to reflect current or projected market prices. Full stop, one announcement, one number, a new anchor. Why does this happen? Because balance sheets break, because confidence cracks, because when trust is thin, collateral matters. Run the scenario. Say they revalue to $20,000 per ounce as part of a new monetary framework. You take 833 tons. Multiply by 32,150 ounces per metric ton. That equals 261.5 million ounces. Multiply by $20,000 per ounce. Now you have $523 trillion in instant value on the government's balance sheet with the stroke of a pen. What can that do? Retire existing debt, recapitalize the banking system, back an expanded money supply, or anchor a new gold-backed digital currency. All options are policy choices, not market outcomes, not the invisible hand, the visible hand, in full view overnight. This is not gradual. There is no gentle glide path. It happens in the dark, then it is morning. Executive order, emergency legislation, Treasury announcement. No warning to the public, no extended debate, just execution. And while investors argue on social media, the window closes. You wake up, read the headline, and the move is already in the past. The opportunity, gone. Panic follows, then regret, then rationalization. If this sounds dramatic, look back. This pattern has played out before. All 4 stages in 1933, again in 1971. Different actors, same script. Do you see the pattern now? We are approaching that crossroads again. The signs are familiar. The incentives are obvious. The math is unforgiving. And when the clock finally strikes, it will not be a whisper. It will be a policy thunderclap. That is what is likely coming in 2026 or 2027. Not a prediction, a sequence, repeated, recognizable, relentless. Most people do not see the pattern until it is finished. Only then do they realize their wealth has already moved, quietly, relentlessly. From their hands to someone else's, October 1929. The stock market shatters. Euphoria turns into dread. Overnight, confidence disappears. Banks begin failing in waves, not 1 or 2. Waves. Depositors line up at dawn. They do not want interest. They want cash. They want safety. Panic feeds on itself. Fear becomes policy. By early 1933, the United States government is staring at an existential debt and deflation crisis, not a routine recession. A system-level failure. Deflation bites hard, prices fall, revenues collapse, but debts, they do not shrink, they grow heavier in real terms. Every dollar owed becomes more painful. Businesses cut, families freeze spending, banks implode, and citizens hoard physical gold because they do not trust paper, not the currency, not the banks, not the promises. March 1933. Roosevelt takes office. The public wants something radical, Not tweaks, not speeches, action. He inherits a machine that is already snapping its gears. The spiral is underway. By that moment, stages 1 through 3 have already unfolded. Stage 1, a government debt crisis. The Depression vaporizes tax revenues, relief spending explodes. The math does not work. Outflows surge. Inflows crater. The books do not balance. Hope is not a budget. Stage 2, confidence breaks. Citizens no longer trust the dollar or the banks. Bank runs accelerate nationwide. Word spreads faster than policy. Everyone tries to convert paper into physical gold. If you had a stack of bills and a family to protect, what would you do? Lines stretch, tellers shake their heads, vaults drain. The Federal Reserve hemorrhages gold at an unsustainable rate. The outflow is a verdict, a vote of no confidence, stage 3. The government edges toward insolvency. It cannot fund programs. It cannot meet obligations. The gold reserves sit at 8,133 tons. But on the government's books, that gold is officially marked at only $20.67 per ounce. Look at that number. Then look at the commitments. The math breaks. The system is cracking. You cannot keep promises when your assets are priced by yesterday's illusion. Do you see the pattern? Then comes stage 4, the revaluation, but you cannot reprice what you do not control. First, the gold must move. Away from the citizens into official hands. April 5th, 1933, Roosevelt signs Executive Order 6102, confiscation. The order declares that all American citizens must surrender their gold coins, gold bars, and gold certificates to the Federal Reserve. Not some of it, all of it. You are allowed to keep a maximum of $100 in gold coins, and only for collectible, numismatic purposes. Everything else must be turned in. Imagine the kitchen table that night, a small pile of coins, a wedding ring, a shoebox of notes, a decision. Do you hold out and risk everything, or do you comply and hope the storm passes? Fear says comply. Fear says do not fight the machine. People file to the banks. They hand over what their grandparents saved. They trade weight for paper. Why does this happen? Because when a system breaks, it reaches for control. Fear drives the public. Survival drives the state. Panic, flight, confiscation, revaluation. It is not random. It is a sequence. It is the same human story told in money. Watch how each stage feeds the next. Watch how trust evaporates, then power consolidates, and ask yourself early, not late. Do you see the pattern now? The penalty was not a slap on the wrist. It was a $10,000 fine. In 1933, that was roughly $230,000 in today's money, or 10 years in federal prison, or both. That was the choice. There were narrow escape hatches, gold used for real industry, dentistry, jewelry manufacturing, little carve-outs with tight boundaries for ordinary people holding coins, bars, or certificates as savings. The message rang cold and simple. Turn it in immediately or face prosecution. And people complied. Most did not argue. They walked to banks with small envelopes and heavy hearts. They told themselves they were doing the right thing. They believed they were being patriotic. They believed they were helping their country in a crisis. Fear pushed from behind, duty pulled from the front. Who wants a federal agent at the door? Who wants to be the holdout when neighbors are lining up? 9 months later, the other shoe dropped. January 30th, 1934. A new law, the Gold Reserve Act of 1934. A quiet sentence in a thick document. But it hit like a hammer. The official gold price jumped from $20.67 per ounce to $35 per ounce overnight. By decree, no negotiation, no appeal. Why does this matter? Because that single move rewrote balance sheets. It manufactured wealth for the state with the stroke of a pen, 69.3% higher, just like that. The Treasury booked an enormous paper profit. All the gold taken from citizens at $20.67 now sat on government ledgers valued at $35. The same bars. The same ounces, a different number, and a different world. What did they do with it? They used the new valuation to recapitalize the Federal Reserve System, to swell the foundation under the banking structure, to justify a dramatically larger money supply. The stated mission was clear: fight deflation, flood the system, stabilize prices, calm the panic. The method was brutal. Transfer wealth, then expand credit against it. Let us break down the transfer. You hand in an ounce. You receive $20.67, full stop. The next act happens off stage. The government revalues that ounce to $35. Your ounce did not change, your payout did not change, but the ledger did. In an instant, citizens lost 41% of the value relative to the new official price. Do you see the asymmetry? Heads, the state wins. Tails, you lose. And it did not end there. It never ends there. Over the next years, the money supply swelled aggressively, intentionally. Through the 1930s and the 1940s, the higher gold valuation became the justification and the backing. The promise behind the paper. Meanwhile, inflation crept, then marched. From 1933 through 1945, the purchasing power of the dollars people received for their gold sank, slowly at first. Then steadily, then relentlessly. What did that feel like on the ground? You thought you had safety. You thought cash meant certainty. But each month, a little less. Each year, a little thinner. Groceries a bit more expensive, rent edging higher, savings buying less. The numbers on account statements stayed the same. The value leaked out, silent, invisible, inevitable. That is how inflation steals, not with a gun. With time. Meanwhile, the government held the gold. It was not just metal, it was leverage. It appreciated on the books at the new price. It anchored the expansion. It gave cover to inflate away the Depression-era debt burden. The promises made in panic were diluted in peacetime. The burden lightened, but not for everyone. The cost was pushed onto savers, onto those who trusted, onto those who complied. Look at the pattern. It is clean. It is clinical. 1933. The crisis hits, debt everywhere, bank runs, lines at teller windows, hands shaking. April 1933, the order comes. Gold must be surrendered. No debate, no delay. Patriotism wrapped around fear. Compliance dressed up as virtue, January 1934. The revaluation hits, upward by roughly 69%. Wealth is reassigned. The system is refueled. Why does this happen in crises? Because power seeks certainty. Because policymakers value control over uncertainty. Because fear is the most persuasive salesman in the world. When people are scared, they trade optionality for safety. They bring treasure to the altar and ask for protection. The state accepts the offering, then writes the rules of the new game. If you were an investor then, your psychology mattered more than your assets. Panic sells, patience preserves. But patience is hard when prisons are mentioned and fines are enormous. $10,000 was life-changing money. 10 years was a lifetime in a cell. The rational brain whispers about principles and long-term value. The emotional brain screams about risk and punishment. Which voice wins when a family is on the line? This is not a morality tale. It is a map. It shows how policy can move value from one set of hands to another. It shows how a legal decree can redefine prices, redefine solvency, redefine who pays and who is paid. It shows how inflation, gentle and polite, finishes the job that confiscation starts. Do you see the pattern now? Crisis, confiscation, revaluation. Inflation, a perfect sequence, executed with precision and paid for by those who thought they were doing the right thing. From 1934 to 1945, the money supply swells. Quietly, relentlessly. Inflation does the heavy lifting. Debts shrink in real terms. The trapdoors open and the government walks out of the debt prison. But someone pays. Savers. Workers. Anyone holding dollars. They watch their purchasing power slip, not in a crash, in a slow bleed. Day after day, the same basket of goods costs a little more. The same paycheck buys a little less. It feels like a fog. You sense it. You cannot grab it. Most people never saw it coming. They believed they were doing the right thing, turning in their gold, answering the call. Patriotism, they were told. Stability, they were promised, but the trade was brutal. They gave up hard money. They accepted paper. And that paper was designed to erode. They thought they were saving the nation. In reality, they were funding their own financial decline. That is stage 4, executed with precision, inflation as policy, a clean escape for the state, a quiet tax on the public. And yes, it is the same mechanism setting up again. Different packaging, same core move. Now jump to 1944, Bretton Woods. Picture a post-war world trying to rebuild. 44 allied nations agree on a new monetary architecture, simple rules. The United States dollar pegs to gold at a fixed rate of $35 per ounce. Other major currencies peg to the dollar, one anchor, one chain, and the crucial clause, foreign central banks can redeem their dollars for physical gold at that fixed $35 price. For about 20 years, it works. Confidence holds, trade grows, the system looks solid, but then the 1960s hit. Vietnam War. Massive military spending, great society, big domestic programs, bills pile up, pressure builds. To pay, the government prints more dollars. Far more than the gold stock can credibly back at $35 an ounce. If you are a foreign central banker, you see the spread opening. You feel the risk. You ask the question that decides everything. Do I want paper promises or the metal itself? Fear whispers, greed answers. Get the gold. By 1971, stages 1 through 3 are in motion. Stage 1, government debt is climbing fast. Stage 2, dollar credibility among foreign governments is breaking down. France under President Charles de Gaulle demands physical gold for dollars. Germany follows, Switzerland follows, the United Kingdom follows. One after another. The message is blunt. We want gold, not dollars. By August of 1971, the United States holds roughly 10,000 metric tons of gold. Sounds like a lot. It is not when you are backing a tidal wave of dollars sloshing around the world. The math stops working. Too many dollars printed. Not enough gold to honor redemptions at $35 per ounce. The Bretton Woods system begins to fail in real time. Confidence cracks. Arbitrage beckons. A run is forming. Put yourself in that moment. You are a saver. You sense the floor shifting. You are a policy maker. You see reserves draining. You are a trader. You smell blood. Which way do you move? Do you hold paper and hope? Or do you reach for anything scarce and real? August 15th, 1971. Sunday night. The nation waits. The world watches. President Nixon steps in front of the camera. Calm voice, firm tone, and then the shocking announcement. The kind that ends one era and begins another. Do you see the pattern yet? Why does this keep happening? Because when the pressure builds, the same playbook comes off the shelf. Different decade, same incentives, same human emotions. Fear, greed, panic. And the same outcome for anyone holding the bag. He calls it a temporary suspension of the dollar's convertibility into gold. Temporary, harmless. That is how it sounded, but in a single stroke, the gold window is slammed shut. Foreign governments cannot redeem dollars for gold anymore. The dollar becomes pure fiat, backed not by metal, but by promises and power. United States government promises and American military dominance. Especially control of global oil flows through the petrodollar system. Why does this matter? Because the next move reveals the pattern. Immediate dollar devaluation against gold. On paper, the official price stays frozen at $35 per ounce. In the real world, once gold is allowed to float, the price erupts. 1971, $35 per ounce official. 1974, $195 per ounce. That is 5.6 times higher in just 3 years. 1980, $850 per ounce at the peak. That is roughly 24 times the old official Bretton Woods price. A 2,329% gain in 9 years. Do you see the pattern? This time, the mechanism is different from 1933. No direct confiscation, no need. The government already controls the bulk of the gold reserves. They do not have to take it from citizens. Break the peg. Let the market reprice the truth. The revaluation happens in the open through market forces, quiet, efficient, brutal, and those reserves, they become a silent hammer. The government's 8,333 tons of gold explodes in market value. From roughly $11 billion at the old official price to over $275 billion at the 1980 peak. Even though the dollar is no longer formally backed by gold under Bretton Woods, those bars do not move. They sit in vaults as a psychological anchor, a strategic asset, a totem of confidence, while the money supply expands aggressively. Meanwhile, policymakers do the math. They inflate away Vietnam War debt and Great Society promises across the entire 1970s. Year after year, inflation runs at 10 to 14%. Prices climb, the unit of account shrinks, fear creeps in, then denial, then panic. Here is the wealth transfer in plain sight: citizens holding cash, savings accounts, bonds, any fixed dollar assets. They lose roughly 80% of their real purchasing power over the decade. It does not feel like a crash at first. It feels like slow erosion. But the loss is real and permanent. Citizens who hold physical gold ride the repricing from the official $35 to the $850 peak, a 2,329% gain. And the government, they accomplish the unspoken goal. They inflate away the debt. They do not default. They let the currency absorb the pain. Their gold reserves soar in market value without selling a single ounce. Optics improve, balance sheets look stronger, the burden shifts. Why does this happen again and again? Because when trust in the peg breaks, human nature takes over. Fear dumps the shrinking currency. Greed reaches for the asset that cannot be printed. Panic seals the move. The pattern is simple. The peg breaks, trust migrates, gold revalues. Debt gets lighter, and ordinary savers pay the bill unless they see it coming. Here's the key difference most people miss. In 1933, the government took the gold first. Then it raised the price, confiscation, then revaluation. Cold, efficient, final. In 1971, they flipped the order. They slammed the convertibility window shut. Then they let the market do the heavy lifting. Gold exploded higher after, no confiscation needed, just a door closed and a price set free. So, what happens next? The critical call is this. In 2026 or 2027, the government will likely revalue gold officially, suddenly, with no warning. And they will lock citizens out of the gains before the public even learns the vocabulary for what just happened. Why would they do it? Because they learned from both eras. They saw what worked, they saw what backfired, and they know most Americans do not hold physical gold anymore. No need to seize what the public does not own. They can do it by policy, clean, surgical, maybe folded into a new gold-backed digital dollar. Maybe wrapped into a debt restructuring. Either way, the effect is the same. By the time you hear the announcement, the door is already closed. The move is already priced. The advantage is already gone. Same four-stage pattern, different execution. The outcome does not change. The state crawls out of the debt trap. Savers and paper get fed into the machine, quietly, systematically. Now bring that pattern into January 2026. Let's walk through it, step by step. Stage 1 is simple: debt at a critical threshold. The United States national debt stands at $38 trillion. The debt to GDP ratio sits at 128%. Do you feel that weight? Do you sense the slope getting steeper? Context matters. In 1933, it was roughly 40% of GDP. In 1971, about 35%. During the 2008 crisis, around 64%. Look at the arc. Do you see the pattern? Each chapter gets heavier, each chapter gets faster. We are in uncharted territory, and the pace is accelerating. The interest on the debt alone now runs at roughly $1.2 trillion per year. Let that settle in. Interest, not roads, not research. not education, just interest. That is more than the defense budget, more than Medicare. It is becoming the largest single line item in the entire federal budget. A bill that grows as rates rise, a bill that grows as debt climbs. A bill that never sleeps. The math does not care about politics. It is unforgiving. Can they raise taxes enough to close the gap? Not realistically. Politically toxic, economically damaging. You can squeeze the orange, but you cannot squeeze it dry without killing the tree. Can they slash spending? Not meaningfully. The commitments are baked in. Entitlements plus defense already consume well over 3/4 of the budget. That is the hard structure. That is the wall you run into when you talk about cuts. So what happens when the math boxes you in? You change the unit of account. You change the rules of the game. You revalue the anchor. That is how governments escape. They do not send you a bill. They shift the ground beneath your feet. Now picture the psychology. Investors hear the headlines. They shrug. They tell themselves it will be fine. They wait. They hope. They scroll. Then one morning, a podium, a statement, a new policy. Gold is revalued, officially, permanently. The market does the rest, prices gap, the crowd panics, the people sitting in paper watch the spread widen. And they cannot get through the door because the door is already closed. Why does this happen every time? Because fear arrives late. Greed arrives early. Denial fills the gap in between. The pattern exploits human nature, quiet pressure, sudden announcement, violent repricing. Order restored, and the public pays. This is not abstract. This is stage one right now. The numbers tell you the pressure is real. The history tells you the playbook is simple. The mechanism may change. The result does not. The state will find a way out of the debt trap. And holders of paper claims will fund the exit, untouchable politically. No one wants to touch the real cuts. No one wins elections by telling voters the party is over. So they stall, they spin, they hope growth saves them. But they cannot grow their way out of it. The compounding is relentless. The interest meter never sleeps. You would need sustained growth of 6 to 7% to outrun an average interest cost of 7% on new debt. We are getting 2 to 3%, sometimes less. The math does not care about speeches. The math does not care about promises. The math does not work. So what remains? Two paths. Devalue the currency or default. History shows the preferred path. Devaluation through gold revaluation. They have used that playbook before, twice. Quietly, surgically, they will call it something else. They always do, but the effect is the same. Your money buys less. Their balance sheets breathe. Stage 1, check, verified, we are there. Stage 2. Is the dollar losing or threatening to lose reserve currency status? Ask who is building the lifeboats. The BRICS nations, Brazil, Russia, India, China, South Africa, plus new members Saudi Arabia, UAE, Egypt, Iran, Ethiopia. They are not waiting. They are aggressively pursuing alternatives, trade without the dollar, settlement without the dollar. They launched a unit currency in January 2026 for trade settlement, 40% backed by gold. Why gold? Because gold does not lie. Because gold does not default. Saudi Arabia is no longer exclusively trading oil in dollars. Since 2023, they have accepted Chinese yuan for oil sales. The lock on the petrodollar is cracking. Do you hear it? That sound is a system losing its monopoly. China's official gold holdings are 2,264 tons. Independent estimates suggest the real number is over 5,000 tons, accumulated through non-official channels. Quiet, patient, relentless. Russia holds 2,32 tons officially. Central bank gold buying globally has hit levels not seen since the 1960s and the 1970s. When the people who print money buy gold with both hands, what are they telling you? They are hedging the system they run. According to IMF data, the dollar's share of global foreign exchange reserves is in structural decline. Year 2000, 71% of reserves were held in dollars. Year 2026, 58% and falling, not a blip. A trend. Do you see the pattern? This is the same signal we saw in 1971. Back then, France and Germany demanded gold for their dollars. They forced the truth into the open. The system's weakness was exposed. Promises met the vault. Paper met metal. The metal won. Now China, Russia, and more nations are de-dollarizing trade flows, building gold reserves as insurance against a dollar break. They are not arguing on television. They are moving tonnage. They are writing new contracts. They are building exits. When foreign governments no longer trust your currency, when they build alternatives in the open, the revaluation is not a conspiracy. It is a timetable. Confidence leaves slowly, then all at once. Markets smell it first. Savers feel it last. Stage 2, check, verified, we are there. Stage 3, are government gold reserves static while debt explodes? Look at the scoreboard. U.S. official gold reserves are 8,133.46 metric tons. That exact number has not changed since 1971. That is 55 years, half a century of motionless ounces while debt balloons into the sky. Think about that. Assets frozen, liabilities compounding, the gap widens. Tension builds. Why does this matter for you? Because during revaluations, wealth does not disappear. It moves. It changes hands. It flows from paper to things, from promises to collateral, from weak hands to strong. Investors feel the psychology before the headlines. First comes denial, then anger, then bargaining, then panic. Smart money front runs the panic. They accumulate when the crowd yawns. They exit when the crowd cheers. Fear and greed tune the market like a metronome. Boom, bust, repeat. You do not need to predict the day. You need to recognize the stages. Stage 1, political paralysis and impossible math. Stage 2, reserve status eroding and gold accumulation accelerating. Stage 3, official gold static, debt detonating. Each box checked amplifies the pressure. Each check brings the same endgame closer. We are not speculating. We are following the map. The map is history. The map is incentives. The map is math. And math, in the end, always gets paid. The only question is who pays and with what. Behind locked steel doors, the gold waits. Not on a chart, not in a rumor. In vaults you can touch if you could ever get inside. Fort Knox, Kentucky, roughly 4,582 tons. West Point Depository, New York, 1,682 tons. Denver Mint, 1,264 tons. New York Federal Reserve, 418 tons. Heavy, real, audited. But here's the twist. On the Treasury's official books, this gold is still marked at a statutory price of $40.2 per ounce. A number set in 1973, never updated, frozen in time. Why does this matter? Because the market does not care about old statutes. At a real current market price of $4,600 per ounce, that hoard translates into roughly $1.2 trillion. That is the hidden asset, the dry powder for a balance sheet transformation, the ammunition for a revaluation. Investors miss this because they watch the daily tick. Fear blinds them, greed distracts them, panic makes them sell the thing that later saves them. The government, it waits, it prepares, it studies the law. Now run the math forward. If the official price is revalued to $10,000 per ounce, the line item becomes about $2.6 trillion. At $20,000 per ounce, it is about $5.2 trillion. At $30,000 per ounce, about $7.8 trillion. Do you see the pattern? At a $20,000 revaluation, that single policy move could retire roughly 14% of the entire national debt. Not with higher taxes, not with austerity, with a pen, a number, and an overnight accounting change that the law already anticipates. That is not magic. That is balance sheet engineering with a hard asset. The government is sitting on an answer that is hiding in plain sight. All it needs is the political cover, a crisis big enough to justify an emergency action, and a mechanism that already exists. The precedent is not fantasy, it is history. 1933, 1971. Moments when the rules of money shifted in days, not decades. The legal framework exists today. The Gold Reserve Act, the Federal Reserve Act. Executive authority, stage 3, check, verified, we are there. Stage 4 is the uncomfortable question. Is a revaluation being quietly prepared? Look at the signals that do not trend on social media but matter in the halls where policy is born. In 2023, an internal Treasury report referenced modernizing the gold certificate ratio. Bureaucratic language, yes. But that phrase is code for revaluation plumbing. You do not modernize a ratio you never plan to use. The Federal Reserve Act already allows the Treasury Secretary to set the official price of gold. Not ask, set. The legal authority is not a theory. It is written. Meanwhile, in policy and academic circles, the conversation is changing. Alternative reserve asset frameworks. Hard asset backing for central bank digital currencies. A theme keeps repeating. Gold as Tier 1 capital under Basel through international banking regulations. Translation for investors, gold is not a relic. It is treated at the core of the system as the safest of the safe. So, where does this leave you? On one side, fear. They would never do it. On the other side, greed. I will wait for a better price. Both are traps. The playbook for revaluations is always the same. First, denial, then a weekend announcement. Monday morning, the number is different and the world adjusts. Those who prepared look calm. Those who laughed on Friday scramble on Tuesday. Do you see the pattern now? Real metal, antiquated book value, enormous gap, clear legal path, quiet groundwork, and a government that needs a lever big enough to move a mountain-sized debt problem. The gold is there, the math is there, the authority is there. All that is missing is the moment. When it comes, it will not ask for your permission. It will not wait for your emotions. It will simply change the price, and everything that depends on that price will shift with it. The pipes are already laid. The rules are already written. Banks can treat gold as a primary reserve asset, not a theory, a framework, built in plain sight. Why does that matter? Because it makes a revaluation possible. Clean, fast, legal. The scaffolding is there, waiting for a spark. Most people walk past it. They see footnotes, not signals. They see line items, not levers. They miss the quiet preparation. They miss the why. So what lights the fuse? A major dollar crisis. Screens go red. Foreign holders sell first, ask questions later. Capital bolts for the exit. The move feeds on itself. Liquidity vanishes. Trust follows. Loss of reserve currency status accelerates. Not an overnight collapse. A grinding shift. More trade settles away from dollars. Then more. Do you see the pattern? Network effects reverse. Confidence drains. Policymakers feel the clock ticking. A debt ceiling standoff that actually threatens default. Midnight votes, closed door calls. Markets stop pretending. Bills come due. The word default hangs in the air. Fear becomes a policy input. A failed Treasury bond auction. Not enough buyers at sustainable rates. Yields jump. Phones explode. Dealers pull back. The cost of money spikes at the worst moment. That is how systems break. A major geopolitical shock, war, the kind that shakes shipping lanes and insurance markets, the kind that touches the Middle East or Taiwan. Dollar flows seize. Sanctions scatter the chessboard. Capital hates uncertainty. It hides. A complete breakdown of the BRICS alternative system that forces a United States policy response, not because Washington wants to, because it has to. A rival mechanism cracks. The spillover hits everyone. Fire breaks fail. Action follows. A banking crisis 2.0. Regional banks wobble, then fall. Depositors move. Credit freezes. Emergency recapitalization becomes the only option. Politicians argue. Balance sheets beg, or maybe it is simpler. The national debt crosses $40 trillion. a big round number, a psychological wall. Headlines scream. Households feel it. The mood shifts from denial to alarm, and once that mood shifts, policy shifts with it. So what happens next? The mechanisms are not a mystery. Scenario A domestic revaluation for debt management. The Federal Reserve and the Treasury stand up together. A joint action. No leaks, no debate. They mark to market the nation's gold reserves at a new price, somewhere between $15,000 and $25,000 per ounce. What does that do? It creates balance sheet room, real room. Roughly $3.9 trillion to $6.5 trillion in fresh asset value, collateral conjured by repricing. They can use it to retire a chunk of Treasury debt. They can use it to back a large expansion of the money supply, or both. One move. Multiple levers. The result is simple. The dollar devalues against gold and hard assets. Quietly but decisively, gold holders are protected. Cash holders pay the hidden tax, purchasing power slips, savers feel blindsided, those who prepared feel calm. Picture it. A retiree checks a savings account and feels the loss. A small business owner who held metal sleeps fine. Same country, different outcomes. That is how policy chooses winners. Scenario B, an international gold-backed digital currency system. BRICS nations launch, then expand. Adoption grows, liquidity deepens. The United States faces a choice: compete or watch reserve status erode entirely and permanently. The likely response? An overnight revaluation. The government posts a new price, $25,000 per ounce. A buy window opens. Citizens can sell gold back at that price, but access is restricted, availability is tight, fine print everywhere. Not everyone gets through the door. Do you see the pattern? Revaluation is a confidence play. It is not about theatrics. It is about collateral, solvency, and time. When fear is rising and trust is falling, gold becomes the fulcrum. Policy leans on it. Markets pivot around it. Most will call it a surprise. It will not be. The structure is already here. The triggers are already circling. The path is already marked. The only unknown is which spark arrives first, and whether you are holding what melts or what endures. Retail gold vanishes in a blink. Shelves go empty. Dealers flip to backorder. Premiums erupt to 50%, then to 100% over spot. You think, I'll wait for a better price. Then the window slams shut. Average people reach for the phone. They hear the same phrase, out of stock. By the time the evening news mentions it, the opportunity is already gone. Too late. That's how this game punishes hesitation. Why does it move so fast? Because fear moves faster than logic. Because crowds stampede. Because whispers in the morning become full-blown panic by night. Do you see the pattern? So what's the real timing, not the fantasy? The historical tempo. Look back, 1933, the crisis turned acute in late 1932. Pressure built, options narrowed. In April of 1933, gold confiscation, not a theory, a policy. In January of 1934, revaluation. The clock from crisis to revaluation, about 14 months, not a decade, 14 months, one turn of the calendar and change. Blink and you miss the decisive phase. Jump to 1971. The dollar crisis intensified in early 1971. Doubt climbed. Confidence cracked. In August of 1971, the gold window closed. The market revaluation began immediately. It did not wait for permission. It continued through the decade. From acute stress to decisive action, a matter of months. When the system moves, it moves fast. Faster than your plan, faster than your comfort. Now, 2026. The debt crisis is not a forecast. It is present. It is acute. Debt sits at 128% of GDP. Foreign holders are selling treasuries, and that selling is accelerating. The likely timeline? 12 to 18 months. That points to a window between mid-2026 and early 2028. Not precise, but tight. Tight enough that indecision is a decision. What should you watch with absolute focus? a debt ceiling showdown. These come like clockwork every 12 to 24 months. Most pass, one does not. The next major one could be the trigger. Watch a significant bank failure, not a rumor, a headline. Stress tests already flag vulnerabilities in regional banks loaded with commercial real estate exposure. 1 weak link snaps, others feel it. Watch the US dollar index DXY. If it breaks critical support and sinks decisively below 95, that is not noise. That is a confidence fracture. Watch gold pierce $5,000 per ounce. That line is psychological dynamite. It tells you the market is no longer debating inflation. It is pricing a currency crisis, and watch Treasury yields. If the 10-year spikes despite policy job-owning, if it blows past 5.5% towards 6%, that is a silent siren. Buyers are stepping back. Liquidity is thinning. The system is demanding a higher price for trust. This is where fear, greed, and panic do their work. Some will freeze, some will chase late. Some will sell the thing that saves them because red numbers scare them more than math. That is the human trap. The market exploits it every time. Now the wealth transfer mathematics. Pay attention. This is not theory. This is your life translated into numbers. Picture this scenario. You own physical gold you purchased at $4,600 per ounce in January of 2026. You made a boring decision when the room was quiet. Then, in 2027, the government announces a revaluation to $20,000 per ounce. Overnight, your position jumps by roughly 335% in dollar terms. But the point is not the percentage. The point is purchasing power. While salaries lag, while savings accounts melt, while bonds bleed, your real buying power holds rent, groceries, energy, tuition. The things that matter do not slip through your fingers. Everyone else is measuring loss in months. You are measuring stability. That is the transfer, from panic to preparation, from late to early, from hope to math. Do you see the pattern now? Windows never send calendar invites. They appear, they snap shut. History does not repeat the headlines, it repeats the tempo. 14 months. A matter of months. 12 to 18 months. Your edge is not being smarter than everyone. Your edge is deciding before the crowd remembers how fast this all moves. If you hold no gold, you hold dollars, paper promises. Dollar-denominated bonds, cash and savings accounts you think are safe. Then the dollar slides, it devalues by 77% against gold in real terms. Your purchasing power does not bend, it breaks. You grip depreciating paper while the largest wealth transfer in modern history moves past you. Quiet, ruthless, indifferent. Why does this happen? Because patterns do not ask permission. They do not require your belief. They do not need your understanding. They do not wait for your participation. Mathematics does not care about feelings. It executes. The British public did not see the pound's devaluation coming in 1931. They trusted the old order. Overnight, it shifted. The American public did not see gold confiscation coming in 1933. They kept cash. They kept faith. The global public did not see the Nixon shock coming in 1971. They assumed the rules were fixed. The pattern ran anyway. Do you see the rhythm? Crisis, policy shock, repricing, inflation, debt relieved, savers punished. Every day you wait is a day closer to the revaluation event. One step nearer to a door that will close without a sound. And when the announcement lands, the window's gone. In a sentence, in a number, gone. This is not fortune telling. This is pattern recognition applied to current conditions. Let's walk through it slowly. 1933, a debt crisis. Pressure builds. Government responds with gold confiscation, then an official revaluation up 69%. After that, systematic inflation erodes the remaining burden. Pattern complete. Government escapes debt. Citizens holding cash take the loss. Not a little. Massive. 1971, another debt crisis. The gold window closes, convertibility ends, markets do the revaluation for them. Gold rises by 2,129% over 9 years. Then inflation does its quiet work year after year. Pattern complete. Government escapes debt. Citizens holding cash lose again. Same movie, new cast, same ending. Now look at today. 2026 is not the future. It is here. A debt crisis with government debt around 128% of GDP. The dollar's reserve status leaking toward BRICS alternatives. Official gold reserves sitting essentially static for 55 years, valued at an absurdly outdated level. The setup is not novel. It is textbook. Revaluation is not dramatic, it is mechanical, it is mathematically necessary and historically precedented. The pattern is completing right now. Why would this be inevitable? Because the mechanism is mathematical and political, not conspiratorial. When government debt swells past the range of 120% to 130% of GDP, and it cannot be repaid through taxes, growth, or cuts, the arithmetic demands relief. When the reserve currency status wobbles, the privilege of slow bleed inflation is not enough. When the government holds substantial gold marked at an ancient official price, the cleanest lever is obvious. Revalue the collateral. Strengthen the balance sheet. Shift the pain from the sovereign to the saver. It is brutal. It is tidy. It is how the book ends. Fear keeps people frozen. Greed pushes them to chase after the move once it is too late. Panic makes them sell the asset that would have saved them. That is the psychology of these moments. Do you see the pattern behind the pattern? You do not have to like it. You do not have to agree with it. But ignoring it will not protect you. Delay is a decision. The math does not wait. The policy will not warn you. History speaks in echoes. 1931, 1933, 1971. Each time the public was surprised, each time the pattern completed. Each time the holders of cash learned the oldest lesson in finance: paper bows to policy, and policy bows to math. It is not a matter of if. It is only a matter of when and at what price level. Here's what you must grasp at a fundamental level. Point 1. This playbook has been run before, not once, multiple times. This is not rumor, not internet folklore. This is documented, verifiable history. Executive orders are public record. You can read them in black and white. Franklin Delano Roosevelt signed Executive Order 6102 in April 1933. It is publicly available. It sits in the archives. It changed the rules overnight. The ink dried and the game shifted. Richard Nixon's announcement on August 15th, 1971 is on video. You can watch it on YouTube tonight. The camera lights are on. The words are clear. The monetary regime flips in real time. Today, Treasury reports discussing modernizing gold policy frameworks are public documents. Not hidden, not coded. You can find them. You can read the language. You can feel the intent between the lines. Why does this matter? Because it proves precedent. They have done it. They can do it. They will do it again when the pressure demands it. Point 2. The wealth transfer is not an accident. It is structural. It is intentional. The mechanism is revaluation. It is how you erase debt that cannot be paid honorably. You change the denominator. You reset the scale. Gold holders, those who position early, do not get rich overnight. They keep what they already earned. In real purchasing power terms, that is the quiet victory, not flashy, not loud, just preserved. Cash holders, most people, feel safe until the moment they do not. Then purchasing power evaporates, slowly at first, then suddenly. Fear takes over. Panic follows. They ask, what happened? It is already done. The general population never sees it until the dust has settled, until it is complete, until it is irreversible. Only then do the headlines explain it to them. Only then do the pundits connect the dots. Meanwhile, the architects of the system are not guessing. Treasury officials, Federal Reserve governors, major banks, they live inside the plumbing. They sense the pressure before the pipes burst. They position accordingly, quietly, early, without fanfare. Do you see the pattern? Point 3. The window is closing fast. Debt stands at a historic record, 128% of GDP, and it is still accelerating. The curve is bending the wrong way. Dollar credibility is slipping, not catastrophically in a day, measurably over time, step by step. De-dollarization is accelerating globally, not everywhere at once, enough to matter. Gold trades around $4,600 per ounce. Up roughly 10 times since 2001. That is not a random walk. That is a signal, a vote. Confidence is leaking out of fiat currency. Quiet, persistent, relentless. The pattern timeline points to revaluation within 12 to 24 months, not guaranteed on a date. Guided by pressure, by math, by politics, by the need to survive the debt. And when will you hear about it? After it is official. After the press conference, after the emergency segment on CNBC, after your feed is filled with takes and threads and outrage. By then, positioning is over. Gold is unavailable, or available at punishing premiums. The door is not closing politely, it is slamming. This is a binary choice. Stay in cash and accept dilution, or position before the announcement and preserve purchasing power. Fear will tell you to wait. Greed will tell you to time the bottom. Discipline will tell you to act on process, not hope. Ask yourself one question. When the headline finally lands, who do you want to be? The spectator asking what just happened, or the quiet professional who already knew how this play ends? There are two doors. Option 1, ignore the pattern, pretend history is a ghost story. Sit tight in dollars, in bonds, in cash and cash equivalents. Tell yourself that this time is different, even with debt towering at 128% of GDP. Even with the same setup we saw in 1933 and in 1971, then the revaluation hits, not as a rumor, as a policy. Wealth destruction arrives silently, then all at once. You watch your purchasing power fade in real time. The number in your account stands still. What it buys shrinks day after day, exactly as citizens lived through in 1933, exactly as dollar holders felt in 1971. Hope does not hedge. Hope does not protect. The pattern is indifferent to your feelings. Why does this happen? Because safety feels like stillness. Cash feels calm. Bonds feel prudent until the rules change. Until the yardstick gets shorter. You check your statements. The balances look the same. Your gut says you're fine. But the grocery bill says otherwise. The rent says otherwise. The sense of control evaporates. Fear takes the wheel. Then comes blame. Then comes panic. Do you see the pattern? Option 2, respect the precedent. Play the game as it is, not as you wish it to be. Allocate a meaningful slice of your investable assets to physical gold and to a lesser extent silver, not as a bet, as insurance. Against currency devaluation, against debt monetization, against the quiet tax you do not vote on, understand the frame. Gold does not rise. Dollars fall against it. The sticker price in dollars climbs because the dollar is being diluted. The scales are being reset. That is the move. That is the policy. You are not chasing returns. You are buying time. You are buying optionality. You are buying the right to not be a victim. Can you stomach the chop? Short-term volatility will try to shake you out. Headlines will mock you. Friends will nudge you back into comfort. But the pattern completes with or without your agreement. Month-to-month swings are noise. The revaluation, when it comes, will not be a market surprise. It will be a policy event, announced, implemented, and then reflected everywhere you spend a dollar. Here's the thread that stitches the story from era to era. The British middle class in 1931 watched the pound unravel. Their paychecks stayed the same. Their costs did not. Confusion turned to frustration. They did not understand why their savings felt smaller each week. The American middle class in 1933 watched the government take their gold for their own good. They were told it was necessary. They were told it was temporary. They did not understand why the rules had changed mid-game. The world in 1971 watched Nixon close the gold window. Overnight, dollars were unmoored. Suddenly, those same dollars bought dramatically less. People were angry, people were stunned, people were powerless. Notice what repeats. The pattern does not ask for your understanding. It does not need your belief. It does not wait for your consent or your participation. It moves forward under the weight of mathematical necessity and the pressure of political expediency. Debt must be managed. Promises must be kept on paper. The path of least resistance is chosen every time. So what can you control? Only your side of the ledger. Only your place in the transfer. Will you stand on the government side holding the revalued asset, or on the citizen side holding the devalued currency? That is the decision. Not tomorrow, not someday. Before the announcement, before the pivot. Before the wealth line is redrawn, ask yourself, do you want to be surprised with everyone else or positioned before the crowd? Do you want comfort today and confusion tomorrow, or clarity today and resilience tomorrow? 2 doors, 1 pattern, choose. What happens next in this series? Precision, no fog. In the next episode, you will see the exact math behind fair value for gold, not guesses. Not hype, real calculations for revaluation scenarios from conservative to aggressive. Why does this matter? Because when fear hits, numbers anchor you. When greed takes over, numbers keep you disciplined. You will see the inputs. You will see the outcomes. You will understand the logic, so you're not pushed around by headlines or rumors when it counts. After that, we go straight into the silver multiplier effect. Why silver can potentially outrun gold by 3 to 1, even 5 to 1 during a revaluation event. The reason is simple but powerful. A smaller market moves faster. A dual role, both monetary and industrial, pulls capital from 2 directions at once. When the herd pivots in a panic or in a frenzy, thin liquidity becomes a runway. Moves that look impossible on calm days become normal in storms. Do you see the pattern? Big money seeks safety in gold, then it seeks torque in silver. Fear protects, greed amplifies. Then comes the full breakdown. Which assets survive currency devaluation? Which assets get crushed? No theories. Historical evidence from every major currency crisis in the last 100 years. Patterns repeat. Paper promises can evaporate. Real assets can hold. Some things that look safe melt away. Others that look volatile quietly preserve purchasing power. Why does this happen? Psychology, incentives, policy reactions, first denial, then sudden repricing, then the scramble to safety, finally the new normal. If you have lived through this cycle on paper, you will not freeze when it arrives in real time. This series exists to show you the pattern while it is still unfolding, while you can still act. Not later, when the wealth transfer is finished and the door has already closed. You know how it goes. Most people wait for certainty. They crave permission. They want a headline that says, "It is time." By the time that headline appears, the move is over. The winners already positioned. The losers tell themselves stories about why this time was different. If this analysis connected the dots for you, you already feel the 4-stage pattern snapping into focus. You can sense where we are on the curve. Are you preparing for a revaluation, or are you betting that identical conditions will somehow produce a different outcome this time? Be honest with yourself. Fear whispers, wait. Greed shouts, chase. Discipline says, decide. The pattern is completing. The timeline is compressing. Your window to act is closing faster than most people realize. Do not be the person who understands it all in hindsight with perfect clarity and zero results. Be the person who chose when it mattered.